Hi, in this video, we will solve a complete comprehensive example under the fifth method of adjustment of capital at the time of retirement of partner. This fifth method is when the retiring partner is to be paid through amount which is brought in by the remaining partners in a manner to make their capitals proportionate to their new profit sharing ratio and also leave a desired bank balance. So let's go to the example sum. Example sum. Sushma, Gautam and Kanika were partners in a firm sharing profits in the ratio of 5:3:2. On 31st March 2019, their balance sheet stood as follows. The balance sheet is there on the left of the screen. The additional information is given on the right. On the above date, Sushma retired and it was agreed that first point, fixed assets will be reduced to rupees 2,90,000. Second point, a provision of 5% on debtors for bad and doubtful debts will be created. Third point, stock was to be valued at rupees 2,18,000. Sushma took over the stock at this value. Fourth point, goodwill of the firm on Sushma's retirement was valued at rupees 8 lakh. Sushma's share of goodwill was treated by debiting Gautam's and Kanika's capital accounts. The fifth point, Sushma was paid cash brought in by Gautam and Kanika in a way that their capitals became in profit sharing ratio and a balance of rupees 58,000 was left in the bank. Last point, Gautam and Kanika will share future profits in the ratio of 2:3. We are asked to prepare the revaluation account, the partners' capital accounts, and the balance sheet of the reconstituted firm. So the point 5, which says Sushma, who is a retiring partner, was paid cash brought in by Gautam and Kanika in a way that their capitals became in profit sharing ratio and also a balance of rupees 58,000 was left in the bank. So this tells us it's the fifth method of adjustment of capital sum. So we'll start with the revaluation account, continue with the partner's capital account, and then the balance sheet. The working notes we will do after the balance sheet. Solution. Revaluation account. Left side debit and right side credit. We have particulars, rupees, particulars, rupees. We'll begin with the first point. It says fixed assets will be reduced to rupees 2,90,000. The current value is rupees 3,60,000. We need to reduce fixed assets by rupees 70,000. To fixed assets account, 70,000 rupees. Point 2, a provision of 5% on debtors for bad and doubtful debts will be created. So, to provision for doubtful debts. %5 of sundry debtors, rupees 1,60,000 comes up to rupees 8,000. Third point, stock was to be valued at 2,18,000 and Sushma took over the stock at this value. The book value is 2,40,000. We need to reduce the value to 2,18,000 rupees. So we'll reduce the value of stock also. To stock account, the difference 22,000 rupees. The fourth point is about the goodwill. The fifth is about the adjustment of capital. And the last point is about the NPSR between the continuing partners Gautam and Kanika. So all the entries are done. We will balance the revaluation account. It's a loss on revaluation of rupees 1 lakh by loss on revaluation transferred to partners capital accounts. The first partner Sushma, second partner Gautam, and finally Kanika. Total amount of loss 1 lakh rupees to be divided in their OPSR 5:3:2. So we have 50,000 rupees against Sushma, 30,000 rupees against Gautam, and 20,000 rupees against Kanika. So this is a revaluation account. Next, we'll prepare the partners' capital accounts. Partners' capital accounts. Left side debit, right side credit. Particulars. Column for Sushma, a column for Gautam, and a column for Kanika. On the credit side again, particulars, a column for Sushma, column for Gautam, and column for Kanika. We'll bring down the balance of the capital accounts by balance brought down. For Sushma, it's 3 lakh rupees. Gautam, 2,50,000 rupees. And Kanika, 3,50,000 rupees. We'll transfer the loss on revaluation to revaluation account. It was 50,000 for Sushma, 30,000 for Gautam, and 20,000 for Kanika as per the revaluation account. There are no reserves. There is an accumulated profit balance of rupees 1 lakh in the liability side of the balance sheet. We'll distribute that by profit and loss account. Rupees 1 lakh to be distributed in OPSR 5:3:2. 50,000 rupees for Sushma, 30,000 rupees in the case of Gautam, and 20,000 rupees in the case of Kanika. There are no fictitious assets. Let's deal with the next point, goodwill. There is no existing goodwill also. As per point 4, goodwill of the firm was valued at rupees 8 lakh. Let's treat goodwill in the working notes. Working note 1, treatment of goodwill. Old profit sharing ratio between Sushma, Gautam, and Kanika is given as 5:3:2. Sushma is the partner who retires. New profit sharing ratio between Gautam and Kanika is given in the point 6. Gautam and Kanika will share future profits in the ratio of 2:3. So let's calculate the gain of each partner. For Gautam, old share 3 by 10 minus the new share 2 divided by 5. We have a negative 1 by 10 and Gautam gains 1 by 10. For Kanika, the old share 2 divided by 10 minus the new share 3 divided by 5. It's a negative 4 divided by 10. Kanika also gains. Hence, the gaining ratio between Gautam and Kanika is equal to 1 by 10 is to 4 by 10, or in other words 1 is to 4. The firm's goodwill, it's specified in point 4 that it is rupees 8 lakh. Hence, Sushma's share of goodwill will be the firm's goodwill, which is 8 lakh rupees, multiplied by Sushma's share in profits, which is 5 by 10, and this comes up to rupees 4 lakh. We'll pass the journal entry for goodwill. We'll debit the gaining partners. Gautam, capital account debit. Kanika, capital account debit. To Sushma's capital account. Amount against Sushma 4 lakh rupees, to be divided in gaining ratio 1 is to 4. So it's 80,000 rupees in the case of Gautam and 3,20,000 rupees in the case of Kanika. So let's post this in the partners' capital accounts. By Gautam, capital account. Under Sushma, we'll write 80,000 rupees. And by Kanika, capital account, 3,20,000 rupees. And on the debit side, to Sushma, capital account. Under Gautam, 80,000 rupees. And under Kanika, 3,20,000 rupees. Next, we'll deal with the third point. The stock which was valued right now at 2,18,000 has been taken over by Sushma. So to stock account, 2,18,000 rupees. Let's pay off the retiring partner, Sushma. Credit side total 7,50,000. Amount to be paid to partner Sushma, to bank account, ₹4,82,000. Next, we'll do the adjustment of capitals. The partner's capital account is in the first half of the screen. Working note 2, adjustments of capitals. The step 1, you need to pay off the retiring partner. pay off Sushma. This has been done. Step 2 is to ascertain the adjusted capitals of the continuing partners, Gautam and Kanika. In the case of Gautam, the credit side total is 2,80,000 rupees minus the debit side total 1,10,000 rupees. This is equal to rupees 1,70,000. And in the case of Kanika, the credit side total is 3,70,000 rupees minus the debit side total 3,40,000 rupees. It's rupees 30,000 in the case of Kanika. Step 3 is to get the total capital of the new firm. For this, we need to add the adjusted capital of Gautam and Kanika. Also need to add the amount which is paid to Sushma, which is 4,82,000. And we need to add the desired bank balance and deduct the existing bank balance. So let's go to the sum. And a balance of rupees 58,000 was left in the bank. So this is the amount of desired bank balance, 58,000. The existing bank balance is given in the balance sheet, cash at bank, rupees 1,40,000, the amount in the asset side of the balance sheet. So minus 1,40,000 rupees. So it's 7,40,000 rupees minus 1,40,000 rupees, which comes up to rupees 6 lakh. So this is the total capital of the new firm. Step 4 is to get the new capitals. In the case of Gautam, 6 lakh, which is the total capital of the new firm, multiplied by his share in the new firm, which is 2 divided by 5, comes up to rupees 2,40,000. And in the case of Kanika, it's rupees 6 lakh multiplied by Kanika's share in the new firm, 3 divided by 5, which is equal to rupees 3,60,000. The final step 5 is to compare the adjusted capitals with the new capital. In the case of Gautam, the adjusted capital is 1,70,000 rupees as per step 2. And the new capital is 2,40,000 rupees as per step 4. So he needs to bring in cash rupees 70,000 rupees. Kanika, the adjusted capital is as per step 2, 30,000 rupees, whereas the new capital is 3,60,000 rupees, and Kanika needs to bring in 3,30,000 rupees. So let's post this in the partners' capital accounts. By bank account, Gautam brings in 70,000 rupees and Kanika brings in rupees 3,30,000. We'll insert the balance of capitals, the new capitals of the partners, to balance carried down. As per step 4, in the case of Gautam, it's 2,40,000 rupees And in the case of Kanika, it's rupees 3,60,000. Both sides tally, then we know our arithmetic is correct. Credit side total for Gautam comes to 3,50,000 rupees. Debit side also totals to 3,50,000 rupees for Gautam. In the case of Kanika, credit side total is 7 lakh rupees and debit side total for Kanika is also rupees 7 lakh. So this is the partner's capital accounts. We'll go ahead with the balance sheet. Balance sheet as at 1st April 2019. On the left side, liabilities. Right side, assets. We'll begin with the liability side items. Creditors, 60,000 rupees. No change in value. Employees, Provident Fund, 40,000 rupees. No change in value. The profit and loss account has been distributed. We'll write the capital accounts of the remaining partners. Gautam and Kanika. As per the capital accounts, the balance carried down in the case of Gautam, new capitals 2,40,000 and 3,60,000 respectively. So it's 2,40,000 rupees for Gautam and 3,60,000 rupees in the case of Kanika. Total 6 lakh rupees. Cash at bank. We approach the sum on the basis of a balance of rupees 58,000 being left in the bank. So the amount here will be 58,000 rupees. We have sundry debtors, 1,60,000 rupees. Original figure. We created a provision for doubtful debts of 5% or 8,000 rupees. So the amount for sundry debtors in the outer column is 1,52,000 rupees. The stock has been taken over by Sushma. It will not appear. Investments, no change in value, 2 lakh rupees. Fixed assets, as per point 1, we reduced it to rupees 2,90,000. Let's check if the balance sheet tallies. Liability side totals to 7 lakh rupees. Asset side also totals to 7 lakh rupees. So this is a balance sheet. I'll remove the split. We can view the entire answer. We began with the revaluation account. Followed by the partner's capital accounts. Then the balance sheet. the working notes. The first working note was for the treatment of goodwill. The second working note was for the adjustment of capitals.